the rule is that my friend Jeffrey Tarrant speaks at a grants conference every 13 years. It's inviolable. He was here in 2004, and fortunately, I have a memory for these things, and we have him back just when he should be, which is right now. Is the microphone on? And you're in low. Well, it's too bad because what I said earlier was really, really funny. Jeffrey Tarrant was here in 2004, and in keeping with the rule that Jeff Tarrant comes back every 13 years, he is with us again. Now, he has been 30 years or so in the investment business, and he is specializing and has specialized in not emerging markets, but in emerging talent, in emerging human beings. He doesn't teach kindergarten. What he wants is to identify young people or new people with fresh, new ideas. And he is, he is a star at that, among many other things. He is likewise the founder and chairman of Move 37, which he created to seek up-and-comers in the intersecting fields of machine learning, data science, and investment management. And his partner, Ted Seides, had this idea a few years ago. He said to Jeffrey, why don't we bet Warren Buffett $1 million that carefully selected hedge funds would outperform index fund over the course of a given number of years? And and Jeffrey said, $1 million is a lot of money. Even when you say it fast, are you sure we should do this? And Ted said, yeah, we got this. So I think barring like the acting out of the grants scenario in the next couple of months, I think they're kind of on the, I think they're actually on the hook for $1 million. But Jeffrey wears that misfortune very, very well indeed. He's a man about it, and he is going to come and tell us about talent and technology, and certainly he is both. So Jeffrey?
Thanks. Hi, so I think it was back in about 1988. I was living in Germany, and that's when I started subscribing to Grant's Interest Rate Observer. And my background, when I got out of business school, I got into the hedge fund business. So that was in 1985, 86, and then I moved to Germany because I had a fiance who wanted to move to Germany, and I ended up working for a billionaire family over there. And it became very interesting because back in those days, the European families like this were the ones that were financing most of the hedge fund business. But my first job out of Harvard, I was working for a company out in Berkeley, California. And we were picking small little hedge fund managers, guys like Paul Tudor Jones, day one with Louis Bacon. And then when I moved to Germany, my partner went to work with a firm out in California and here in New York called the Renaissance Medallion Fund. He's been there 28 years. So, you know, a lot of these managers that I had been investing with and we had invested with had become, you know, household names in some of the better performing hedge funds out there. What was explained by Jim is that Ted Seides had picked up a bet against Warren Buffett. Ted Seides is my former partner. He's not been with us for about 1.5 years or so, possibly 2 years. I believe in indexation, but I believe as that being a part of a total portfolio. And hedge funds, I think, augment a portfolio. They're not to replace a portfolio of equity beta risk. But anyway, so I was the sole CIO of the firm all the way from starting way back when to 2011. And we had then, and I and my team have been searching for the next generation of where things are going to go. And I want to share a little bit about that with you. So we have a title here, Buffett, Boggle, and Brains. And so what I've spent most of my career doing is trying to find the smarter people, not the smartest people in the room, but the smarter people that are out there, smarter than me, people that really know either by specialization, or for whatever reason, they know their area very well. And I just want to make sure that you understand, because towards the end of this presentation, you're going to see things that you're going to think, oh, these guys are interested in quant and sort of investing from a machine learning standpoint. And it doesn't mean we see this as a substitute. We see it as an augmentation also. We still really believe in hedge funds that have an edge, that have either by doing small, mid-cap, off-the-run credit, very detailed analysis, and even large hedge funds that are doing things like we heard today, activism, and things that are very hard to do. But in the general area of large cap stocks, and when I started in the business, the hedge fund world was probably, in size, you'll see some numbers here, but today it's maybe around $500 billion. Today it's north of $3 trillion. So let's just take a look at that. Half of the money in the hedge fund industry is in long-short equity funds. And many of those funds have just raised enough money so that they're in the $4 billion plus range. All of those hedge funds have to be in large cap stocks. And so the question is, what happens when the hedge funds migrate from their former expertise into the area that we're talking about? So how do I change this? So here it is. Okay, so let's go back a few years. So Jim said that I spoke here in November 2004, and he asked me to speak on the hedge fund bubble in 2004. So I changed the subject on him. I went through and we analyzed and we said, is there really a bubble? And somebody else here today defined what a bubble was. But one of the ways that I indicate whether there's a bubble or not is if you've had massive growth and capital inflows going into any sort of area, any sort of asset class, generally that will lead to an overvaluation. And so that's the one things I looked at. And so the way I looked at it is I said, well, wait a minute. A certain amount of flows have come into hedge funds, but look what's really, really happening here. There's massive amount of inflows coming into CDS product, and banks are holding on to these risks. And so my conclusion at the end, the last page of that presentation was, what's riskier? A low leverage hedge fund that usually buys credit default swaps to hedge their risk, and that's what was happening back there, or highly leveraged bank that were issuing the CDS and some of them retaining them on the balance sheet of their books. So one of the things that I did was, there's a book out there called The Greatest Trade Ever, and it's about John Paulson and Paolo Pellegrini, and there's a little bit about me in there. Nobody would finance that short subprime trade that John wanted to do. We did. That launched him, and that was a lot of fun. It worked out very well. So here's the hedge fund industry today, and as opposed to, we used data when we were talking the last time at the conference, and the data was really from 2002, even though I spoke in 2004, and the size of the industry was about $500 billion. And here's where we are today, as I mentioned, about $3 trillion. But the point is, if you go over to the right-hand side, the top 10 hedge funds in the world are managing the entire amount of capital that was in the hedge fund industry back when I gave the previous speech. And so concentration is one of the issues that's out there, but also the fees, the terms, a lot of things have changed in this industry. For example, one thing that our team has written about is we highly object to something called there used to be something that was called a fund level gate. That was if everyone wanted to go for the exits, the fund could freeze assets. But then the lawyers instituted something called investor level gates. And at that point in time, that's for a fund that has might have liquid assets in their portfolio, but they can put a gate up for an investor that wants to get out of the fund, even though they have no liquidity crisis. So we think the industry has kind of swung over too far to restrictions. And here's another of that previous 13-year ago presentation I made. I want to highlight two things, because what I was trying to highlight on this page was, if you take a look at the hedge fund business, it's highly profitable. And as a matter of fact, back at that time, the hedge fund industry could have the revenues of the entire mutual fund industry, right? And so, but here's what I want you to focus on, is the fee structure, where the big red is here. It said that our assumption was a 1 in 20 fee structure. You know, we've kind of gone to a 2 in 20 fee structure, so that changed. But on the left-hand side, I think it's incredibly important to take a look at this. is look at the assumed rates of return that we were talking about in the hedge fund business. They weren't 8% or 9%. These were 15 to 30%. This is what hedge funds were doing and performing back in those days. And so when David Swensen wrote his book in the year 2000, and maybe that created somewhat of a hedge fund bubble, but the portfolios that I had and I created, we were getting mid-teens rates of return year in and year out without taking a lot of beta risk. So let's kind of have fun with the Buffett bet. So Ted did the Buffett bet, and so Protege is on the label of this Buffett bet with him. But it's actually, even though we're losing, and we probably will lose, as I always like to look at the brighter side of things, and let's take a look at that. In that bet, in order to have a $1 million bet, we had to post collateral, and what we wanted to do was have both of our collaterals, Warren's collateral and our collateral, mature to $500,000 at the end of the bet, which was a 10-year period. So we both bought 0 coupon bonds on January 1st of 2008. So we had to put up $330,000. And so the way I look at it is Warren then invited us to have lunch and dinner every year, and we got to go out there. And if you would have bought that on the open market, which there is a charity that he allows you to buy that lunch with him, that would have been a total of $24 million. So I think that was a pretty good value bet. One thing that's really important is that Buffett put out notice around the world that he was looking for a successor. And he didn't find one, he found 2, right? And I always tease him about this. There were 2 guys, and where did he find them? He didn't find them at Fidelity. He didn't find them at Wells Fargo. He found them, they were both running small hedge funds. So I say, thank you, Warren, you just endorsed everything that I do. And then he responds this way, Jeff, they're not hedge funds. And I said, right, Warren, that's only because you're tying one hand behind their back. They can't short anymore, right? So in his definition, they aren't, and so they have to deal with large cap investing, but that's where he found his talent, so they endorsed what we do. And then the last thing is, a lot of people don't know about this, but this was written in the Financial Times not too long ago because they interviewed me, is what we did is we posted collateral, and then you can imagine buying a 0 coupon bond on January 1st of 2008. What would have been better than that? And it went up, and then Warren called us up and he says, hey, we've made a lot of money off this. Do we really think it's going to continue? Why don't we do this? Why don't we buy Berkshire stock right now? So some could call it market timing. Maybe it's not. I don't know. But anyway, so that's what we did. So we bought Berkshire stock. And so here's the charity. And by the way, Berkshire's up again this year. So these numbers look like close to 200%, just under it. So the charity is not going to get $1 million. The charity's going to get $2 million. So the charity won as well. So we happen to agree, though, this is the primary point, we happen to agree with Warren about the fees in the hedge fund business. And that's his primary contention. And so there have been other arguments about what works or not, but we agree. And so we've written a paper, and it's in a P&I magazine, and it says, in the old days, hedge funds would give you a mid-teens rates of return, but the problem now is they are charging 2 and 20 fees, and that's the blue line. And what it shows you is beneath that blue line how much the investors keep at different rates of return. So for example, at a 5% underlying rate of return in a portfolio, an investor would keep actually less than 50%, 48% of the profits. 52% of the profits go to the hedge fund manager. That's mathematically insane, right? So we have come up in our paper and we said, let's try this, a 1, 10, and 20 sort of structure. 1% management fee, just like the old days. A 10% incentive fee until you give us a 10% net rate of return. And then we'll give you a 20% rate of return. We'll give you a catch-up. And so you get back asymptotically of what you would have gotten us if you would have given us low teens rates of return. That's what you're supposed to do. That's what the whole industry is all about. Even though we're at very low interest rates today, it's not interesting to me that the fact that the world has 1, 2, 3% bond rates, that you should get a 2% management fee and 20% incentive fee because the interest rates have come down. If you are a good hedge fund manager, give me a mid-teens rate of return, I'll pay you very well. And that's what we're doing. So where's the next bubble? So you kind of have to look at growth and look at this chart. So these are index fund assets. And one of the first places I worked in my career was at Wells Fargo. And a lot of people don't know this, but here's a trivia question. You know, who invented the index business. People think it was Vanguard. It was Wells Fargo Investment Advisors. Then it became Wells Fargo Nico. Then it became Wells Fargo Nico sold to Barclays. And then Barclays sold to BlackRock. And BlackRock is basically one of the largest index managers in the world. And so here's an aside, just so you know. It was in 2010 that I think Berkshire then became part of the S&P 500. So when Ted came into my office one day and he says, hey, I think I can do this bet against Warren Buffett, I said, are we betting against Berkshire or the S&P 500? He says, S&P 500. So we're out in Omaha, Nebraska, and about to get into Warren's car, and he's going to drive us to dinner. And I said, so Warren, I wanted it. Our bet was against the S&P 500. I didn't want to bet against Berkshire stock. And for every dollar now that goes into the S&P 500, about 1.5 or 2 cents goes to you, to your stock. And he looks at me and he goes, do you give up yet? So maybe we should have. So the next page is quite concerning to me, because at what point does this all stop, right? And so look at this dotted line here, and forget about the trillions of assets that are going in. But the equity index fund, the market share of these index funds is 34%. So my question is like, when does this end? I mean, is it at 40%, 45%, 50%? And what does the world look like when that happens? And then these are components of the S&P 500. And just in 10 years, this is what happened. It used to be, well, basically, the ownership has switched and tripled that from prior ownership of passive funds, and it's now tripled on average. And the other concern that I have is that the biggest index companies in the world, the Vanguards and the Barclays and a few, they own probably about 80% of all indexation. So what happens when just a few asset management organizations own big chunks of these companies? And what happens to corporate governance? And we heard about activism earlier today, but that who's watching over investors' rights? Is it Wall Street issuing new securities on behalf of these organizations? And is that kind of letting the fox into the hen house? I don't know, but who's going to be guiding, these companies? This has been talked about a lot. We had some great presentations this morning, but here's what I see in our business. People used to talk about the global experiment of central banks, and their assets have tripled, but we have no data on how these things end, because this is the first experiment, right? And also, all of these countries, and for example, the euro, that's a new currency. It's only been around, 20 years. And they're all fiat currencies. But we do have data on fiat currencies. And what does that data say? It says every single fiat currency system in the world in history has failed. So let's see where this all goes. So I'm always searching for brains, as I told you, for the smart people. I've had conversations with Jim before, and he's always answered, everybody's smart. Right? And look, I've been around the world, and I could counter that, Jim. Not everyone's smart, but that's what I'm looking for. But let's go back and look at Buffett, right? So is he smart? And he's incredibly smart. I wish everyone could spend the time that we have spent with him. His judgment is, I think, pretty amazing. But is he unconstrained? And this is a really important question. He can only invest in large cap stocks. He can only invest for the long term, and everything says that's good. But his long term is extremely long term, because he has to own a big position in these organizations. And he cannot do any short selling. So he's not really unconstrained. Now, Bogle, who is Mr. Indexation, I'm not saying that Mr. Bogle does not have brains. That's not what I'm trying to say here. The strategy does not use brains. The strategy does not use judgment. And the strategy is long only, right? And what I'm saying is that at this point in time, do you really, really want to go long only right now? And so the question is, so do you dig deep like Jim Chanos was early this morning? By the way, I met Chanos in the old days when he used to share offices with Soros, and there was a young guy sitting behind him, Scott Bessent, and so that was a long time ago. Jim and Scott did some of the best deep dive research. We're also looking at, how do we spend our time? Do we look top down? And so, and Jim has talked in his most recent letter, or maybe a letter about 2 months ago, where he was reminiscing about how this industry used to look in the old days. And I experienced some of the same things that Jim was talking about there in the old days, like having, double ledger green accounting sort of entries, which when I reported to an industry II analyst, he made me run those numbers before Lotus 123, before Microsoft Excel, right? And by the way, that Del Procota over at Soros used to make his analysts actually write down figures so that they had better touch with these figures. But so what's next? And so, life throws you curveballs, so I can't guarantee you what next is going to be, what I'm about to tell you. But even after I met Jim earlier in the spring, and I agreed to speak at this thing, I got thrown a curveball, and that's why I'm wearing a hat. And earlier today, they talked about the man, Byrne, who was running Overstock, who was getting over some health issues, so part of my hair is gone because I went through some treatments. And so it makes me kind of sit back and look at my life, what I've achieved and where I'm going. And it's kind of interesting, last night I was reading something, and now we're about to enter into a whole new, different part of the presentation, is I think the world has changed dramatically. And if you guys don't recognize this, you don't recognize it at your own risk. And the old school of how we did the investment process has completely changed. And that's what I've been spending the last 3 years doing, is running around the world asking whether a small team can do what large teams used to do in asset management. And the answer has been, I think that it's possible now. And you're even seeing large organizations change their organizations because of that. And so I have friends, I'm focusing on health, friends and family right now, but I still pursue this business idea. And I have people look at me like, are you crazy? Why don't you can retire. Well, you made all this money. What are you doing? And when I was reading this thing last night, there's this, in machine learning, in successful machine learning, there's something called neural networks, and there's this whole new theory coming out about the bottleneck in neural networks, and it could be the answer about how the brain really works. And so I was reading, and the guy who is known for writing about this and having this theory years ago, he said, thinking about science and the role of my old ideas was an important part of my healing and recovery. So what you're about to see is important to me, and it's a part of my healing and recovering. And I didn't have to disclose that to you, but this is where we're going. Before you can figure out what's next, you have to figure out what were the game changers? What's changed in the world? And I'm not going to spend a lot of time on this page, but there's enormous growth in data that's never been experienced in the history of the world. New data science and structuring platforms have never been ever represented like they've been represented today. Machine learning is finally working. Artificial intelligence was an idea for decades that was not working. It's finally working. Low-cost, on-demand, scalable computing allows the industry to drop their fees, even the hedge fund industry, which I already talked about that model. And there's a regulatory reason why all of this works. And in the hedge fund world, I used to be in front of people who would tell me, I do retail and apparel and footwear stocks. I go golfing with Tommy Hilfiger. Wink, wink, I know what's going on, right? Okay, so we'll get back to that. So, next page. I'm going to get through this quickly. The old world of data was this. It was structured financial data, and you guys probably remember in the old days, they had Quotrons. And I remember that's when I had my first job, they had Quotrons. Bloomberg didn't come till later, but Bloomberg, Reuters, they organized the data, so that's how you analyze it. Now there are 3 other quadrants that are out there. There's unstructured financial data, like SEC filings. You have to go in and dig and find them. And then there's non-financial data, which is structured and unstructured. I don't want to get heavily involved. The bottom here, ALICE, it stands for Autonomous Learning Investment Strategies. So the new province, the new area of data is structured and unstructured, and we call it the 4 quadrants. What's also unprecedented, the 4 quadrants of data are growing at the rate of Moore's law, doubling every 18 to 24 months, something like that. That's never happened before, right? And so you have different structures of data growing at the rate of Moore's law. You have a whole new career that's out there, which is called data science. Data scientists are in very high demand. 8 years ago, there was no such thing as a data scientist, right? And what do data scientists do? They create platforms. And what do the platforms do is it takes all those 4 quadrants of data and figures it out to parse, categorize, classify. And now you can analyze data. Now let's go back to those other 3 quadrants of data, and just, if you don't believe that they're growing at the rate of Moore's law, it's all coming through your mobile devices, it's through your websites that you're visiting, it's growing at a fast rate. And so this is what's happening. The second unprecedented thing that's happening is data science is organizing that data. The third thing that's unprecedented is machine learning, and it actually works. And what is machine learning? And you need to know what it is first. Basically, machine learning is when a computer learns autonomously by itself. It's not programmed. So the old world, and I don't want to pick on Renaissance or anything like that, but let's just look at the old world of computational finance. It was hypothesis-driven with a lot of PhDs that were coming up with ideas, testing it on a computer, and running models and seeing which models work. Today, that's not the way the world works. Machines go in, and they take data, you input data, and you tell them what sort of output it wants, and it comes up with models, model after model after model, right? So then what you really need is you need a few people that understand that and then can simply say, is this model too silly or not? Like, is the number of squares in this carpet correlated to the Russell 2000, yes or no? Gosh, that seems like a silly thing, let's throw that model out. So this is how the world is working today, and you're seeing it represented. And the first thing is, if you don't believe this, I suggest you watch this TED Talk, and it's by Jeremy Howard. It's 2 years old, and you will understand where the world is going so far as machines that are beginning to think. Let's go to the next level. The question is the investment game just too complicated to figure out, right? And so what we have here is we have, in the old world of hypothesis-driven programming, checkers and chess champions were beat in, the first one took 38 years to program, and the second was 12 years, when Garry Kasparov was beat by Deep Blue. Now, the Go game that only happened a year and a half ago, and this is after we had been running around the world trying to figure this whole thing out. And so this was proof positive for us, right? It happened in only 6 years, and is predicted to take 100 years because there's so many permutations of Go. And so what had happened was AlphaGo, which was created by a company in London called DeepMind, which then was sold to Google, went after the Go champion and beat him, and so the champion was Lee Sedol, and we'll get back and talk about that a little bit later. The criticism of what I just showed you about board games is there are 2 things: is all the board pieces, the players or whatever, are up on top of the board, so you see everything. The visibility is one thing. And the second thing is the finite number of moves. Now, the number of moves that you saw at Go were 10 to the power of 700. That's more than the number of atoms in the universe. Not stars, atoms in everyone's body and everyone's chair here in the universe. And so it looks like it's infinite, but it's not, but it's finite. So that's the criticism. This next page is actually revolutionary. My first day at Harvard Business School, the teachers told me this, is we are going to teach you how to make decisions under conditions of uncertainty with incomplete information. So what happened was 2 professors at Carnegie Mellon and a machine, basically what they did is built a machine that beat the top poker players in the world, but not by a margin, by a factor of so large that what happened was the machine learned how to bluff against each player. So it's not only conditions of uncertainty, but it learned a human trait, right? There's a book outside, by the way. I asked Jim about this. It's written by Joy Ito. It's called, what's the book called? It'll come to me in a second. Anyway, grab the book out there, and you'll see that he talks about this in the context of, or he talks about the AlphaGo winnings, and he talks about how computers are beginning to think like humans. So this is where I don't want to overemphasize this, because this is not what we're about. But if you want to learn about machine learning, and I do reading about it, and I told you about what I read about last night, is there are different categories of machine learning, different methodologies. And many of these are decades old, but they could never have been exploited because the computational power didn't exist. So why is this available today? Because of another unprecedented event. The cost of computational power has collapsed. This is a logarithmic chart, so it doesn't look like too much of a collapse, but it has. Just to give you a rough idea, in the time period, when Renaissance was set up in business, it cost them about $1 million for a certain type of computational power. That computational power now costs less than 4 cents. And we don't mean to be glib about this thing. Machines don't own houses in the Hamptons. But think about that. Are the companies that are experiencing this collapse in cost passing that through to their investors? Or are they just going to keep the alpha to themselves, either in the, by kicking you out of the fund, which is most of these quantitative funds have done that, or charging you high fees? So it's not only the fact that computational cost is so cheap, it's available over the cloud. You don't have to have any storage whatsoever. And I just want to give you a live example of something. There's a guy that worked at Amazon Web Services, and he left, and he joined another friend of mine. They started a company, and this was now about 6 months ago. And he went back to Amazon Web Services, and he says, I've been here a long time. Can you give me a great price on something? Right? And so they gave him a great price on the data and the services, and let's say it was 100 cents. They walk across the street to Google. Google really wants to get into this business, and Google says, we'll do it for 15 cents. And the guy, they didn't even know the 2 people. So it's not only these prices that are coming down, it's at the margin, the pricing is collapsing. So I need to spend a few minutes on this, and I hope hopefully I have enough time, but let me try to get through this. I think the investment process is changing from this, and it's all about process. So there are 3 types of managers there. Discretionary managers, quant managers. ALICE stands for autonomous learning. This is this new generation. Okay. But we have been told, consultants have been told, endowments and foundations have been told that there are 3 forms of alpha generation to when you select a money manager. And the first part is, what is the repeatable process? How is the manager really doing what they're supposed to do? And first of all, the term repeatable process I think is kind of awkward, right? Because it assumes wash, rinse, and repeat, that you do the same thing over and over and you generate profits. And maybe that's good in the areas of very complex things. And we were just talking about things like activism. Yeah, that's right. But when it comes to the process in large cap stocks, what is the process? Okay, so there are 3 things. It's your information edge that you have. And remember we talked about, hey, do you go golfing with Tommy Hilfiger? it's how you process that information. And then the third thing, what is your judgment on the portfolio? Who is Paul Tudor Jones? Who's George Soros? And the first thing I want to do is just show you the information edge hasn't changed until today, because in the year 2000, Reg FD basically said all publicly traded companies have to issue any information at the exact same time to all investors. So that edge that was there before is gone. But what happened was, it just kind of kept on going until another unprecedented event happened. A money manager, who shall remain nameless, paid a $1.8 billion fine, never heard of in the history of this country before, and one of his employees went to jail. So you're now a hedge fund manager, you're managing $5 billion or so, you're pretty wealthy. You have a decision tree now. Do I go golfing with Tommy Hilfiger, maintain my information edge, or pay a fine or go to jail? So you back off your edge. And so here's what I'm going to say. You back off your edge, where do you end up at? You end up in 4-quadrant data land, like everyone else. Okay, so the next column is, okay, now who's going to process that information? And I don't want to denigrate my alma mater, but I went to Harvard. And a lot of those analysts are Harvard, Wharton MBAs that sit there and sift through all sorts of documents and things. And actually, because you're in the data world, you're going to go to a different area. You're going to go to MIT, you're going to go to Caltech, and you're going to get astrophysicists who know how to analyze quantums of data. So that's where you're going to go, and I'll get back to that in a second. And the last thing is, all right, who is a great hedge fund manager? Usually you try to pick someone who's smart. Remember I told you I'm looking for smart and smarter people than me with really good brains, but they also have something called pattern recognition. And so if you go back and you read some of Malcolm Gladwell's books, like that one book, Outliers, he says, what is that? What is your gut? What is that? And he says it's your 10,000 hours, right? So let's go back and look at how the AlphaGo machine won. It taught itself. How did it teach itself? There was a camera, and it watched games. And it watched game after game after game after game. Now, let's imagine that each game was an hour long. And let's imagine that then it watched 10,000 games. That's its 10,000 hours. We're at this point now where actually experience, human experience, or whatever experience, is crossing data sets. And I'm not saying it's better or anything, but we're at that point, and we need to recognize it. And so now I want to go back to the middle. And in the middle, remember, who is processing that information? And I just took this presentation to see my old Harvard professors. One is running a big investment firm, and the other one is still at Harvard. And I said, remember what you guys taught me. It was process, process, process begets performance, performance, performance. And you were saying, hopefully the performance is skill over luck, and sometimes it's hard to tell the difference. But you said, remember, how to keep it going is culture, 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 right? And so just imagine this. You've got a hedge fund with 150 employees, a bunch of Harvard MBAs and Wharton MBAs. And so now you've recognized this. And so you're going to hire a bunch of MIT, Caltech engineers. How are they going to mash together? And so that's going to be a culture crisis. I'm almost there, Jim. So almost there. So I'm not proposing that this is machine only. As a matter of fact, Gary Kasparov, what he did is he set up a new form of chess, and he calls it advanced chess. And what he's found out is that man plus machine always beats machine and man. Machine beats man all the time, but man plus machine beats both. So the last one is, here's what we're thinking the world is going to go. It's going to go towards these autonomous learning investment strategies, and it's going to be the combination of 4 quadrants of data, structured and unstructured, data science and data science platforms, machine and autonomous learning, man paired with machine, and pass-through benefits of the collapsing cost structure, so that you, as investors, can enjoy more alpha than what was shared to you by historic managers. And lastly, if anyone wants to know this, we're called Move 37 because everyone asked me, and I didn't mean to wear this as an advertisement. I was just covering my head. In the AlphaGo game, which was watched, by the way, by more people than watched our Super Bowl. And why is that? It's because it's a huge game in Asia. the machine made a move against Lee Sedol, who was the champion, and it was on the 37th move that all the experts in the industry said, who unplugged the machine? There's something wrong with the machine. Joy Ito's book even talks about this, and I didn't even know that he was going to write about this in his book. I learned later about it. But what happened was Lee Sedol walked back into the room. He left the room, came back 15 minutes later, and knew that he was toast. And so that was the first time that the machine started thinking outside the box. And so that's why we're called Move 37. I don't mean this to be a commercial, but everyone asks me about this, so you don't have to ask me anymore. So any other questions? We're almost done, right?
Yeah, a couple of questions would be very nice. Thank you.
Yeah.
You're dealing with games which essentially are closed systems with fixed participants, whereas the investment process is a series of overlapping people with different motivations, with constant feedback loops, and widely varying institutional structures. How well do you think people are going to be willing to trust systems of this kind once you get beyond relatively short-term and closed loops of activities, of economic activities? Because it would seem as though you ultimately have a high degree of probabilistic behavior, and will people be willing to repose that kind of confidence in an automated system?
Mm-hmm. Well, so would you consider the game of poker a total closed system without human interaction?
I'd consider it a much simpler system than a financial market with different players with widely varying time horizons and several orders of magnitude larger number of participants.
So would you consider a game which is a multiplayer game also a closed system?
I'd have to know the rules of the multiplayer game, and I'd have to know the horizon.
Yeah, I think that's what you should pay attention to if you'd like to, because the other thing in Joy Ito's book, I recommend you have a chance to read it, is he says at the MIT Media Lab, there's a group of 25 to 35-year-olds that while you went to have cocktails at your friend's house, they were in the basement playing multiplayer games. And their brains are wired differently, right? And they're wired differently, and they not only know how to play the game, they know how to play the player, right? And so if you're saying that the closed loop is the game, I'm saying you're probably right, but playing the player is an open loop. And it's already happening. And so I would just suggest not to listen to my answer. Just go meet a couple of 25 to 35-year-olds who are former world champions in games. By the way, do you know what the fastest growing sport in the world is today? Any idea? It's esports. People watching other people playing multiplayer games. And they're just sitting in massive stadiums watching them. So if we're not there, we're getting there is what I'm saying.
Thank you.